The rich really are getting richer. Let's bring in Craig for some common sense. Craig is the co-founder of VestGen, as well as a financial advisor. Good to see you, Craig. The K-shaped economy is likely going to be a popular buzzword in 2026. Explain why it's being called a K-shaped economy.
A minority of the population doing so incredibly well, where a large swath of the population continues to deteriorate. And the reality to that answer is it can go on a lot longer than people think. Now, that doesn't dehumanize in any way, shape, or form the toils and struggles that Americans are dealing with. But the reality is it's always been the high income earner, the high end consumer who has driven a large swath of the T&E. That's, travel and entertainment inside of this country. And I think we're continuing to see that. But longer term, everybody knows for the health of the U.S. economy, for the health of all investors, we need to find a way to bridge this K-shaped economy, which is going to begin with stabilizing the bottom portion of that K first to make sure that chasm doesn't grow any larger.
But when you have millionaires and billionaires making more money and the middle class and lower income Americans with less extra money to spend, what will that mean for investing in 2026? Do investors need to be cautious?
All right. Well, when we have a K-shaped recovery, investors of all shapes and sizes need to be mindful of a couple of things. The first thing that pops to mind is being mindful of credit spreads, credit default swaps, et cetera. And there's nothing that appears to be the harbinger of a recession pending or brewing for the immediate future. But if you're a long-term investor or a high net worth investor or any form of investor, you need to look under the hood at what it is that you own. And I would argue that if you're in a K-shaped recovery, the longer that K-shaped recovery endures, the more you want to focus on quality on the credit side, because everybody should be worried about the return of their capital first, the return on their capital second. And I think that's playing out already with some of the headlines you've seen and the increase in personal bankruptcies. That's chapter 7, 11, and 13. I think some of that plays out in some of the headlines that you saw in September and October relative to the subprime auto market. So going into January of 2026, let's make sure all investors pay attention to what they own relative to credit and make sure if this economy continues to maintain its K-shape without stabilizing the bottom portion of the K, that we move up in credit quality. If you want to learn more, we encourage you to. We want to connect with you. Find us online at getretiredstayretired.com. That's getretiredstayretired.com.